In 2021, a bombshell report came out showing that some of the wealthiest people in America, billionaires worth tens of billions of dollars, had paid almost nothing in federal income tax for years. Not because they cheated, not because they broke the law, because the tax code was built in a way that made it completely legal. And here is the part that nobody talks about. The same system they are using, the logic behind it, is not completely out of reach for ordinary people either. Today, we are going to pull the curtain back on how this actually works. The income illusion. To understand how billionaires pay so little tax, you first have to understand something most people get wrong about how rich people make money. You probably think of income the way most of us experience it. You work, you get paid. That pay shows up in your bank account. The government takes a percentage before it even arrives. That is called earned income, and it is the most heavily taxed kind of money there is. Now here is how it works at the top. Billionaires generally do not pay themselves large salaries. Warren Buffett famously paid himself around $100,000 a year for decades, a tiny fraction of what an ordinary CEO earns. So if he is not taking a big salary, how does he have money to live on? His wealth sits in assets, stocks, real estate, business ownership. And assets are not taxed just because they go up in value. If you own stock worth $10 million and it grows to $50 million, you owe zero tax on that $40 million gain, as long as you never sell it. This is called unrealized gain. And it is the first pillar of how the ultra-wealthy build enormous fortunes while showing almost no taxable income. Borrow, don't sell. So if they cannot sell without triggering tax, how do they actually spend money? They borrow against their assets. Here is how this works. You go to a bank. You say, I own $50 million in stock. I would like a loan of $5 million, and I will put my stock up as collateral. The bank says yes. You get $5 million in cash. You pay no income tax on it because a loan is not income, and your stock keeps growing in the background. This strategy even has a name. Wealthy insiders call it buy, borrow, die. You buy assets. You borrow against them to fund your lifestyle. And when you die, your heirs inherit the assets at their current value. A rule called the stepped-up basis, which means the decades of gains are never taxed at all. The loan interest you pay on these borrowings is often very low. Major banks offer wealthy clients what are called securities-based lending lines at rates that regular people cannot access. And because the loan is secured by assets that keep appreciating, the bank takes very little risk. You are essentially living off borrowed money secured by a growing fortune, never selling, never triggering income tax, and passing the whole thing on tax-free when you die. The capital gains advantage. But let us say they do sell something. What happens then? This is where the second major pillar comes in, the capital gains tax rate. When you sell an investment you have held for more than 1 year, you pay long-term capital gains tax, not ordinary income tax. In the United States, the top ordinary income tax rate is 37%. The top long-term capital gains rate is 20%. That is a massive difference, nearly half the rate. And it gets more interesting. If your taxable income in a given year is low enough, because you are living off loans instead of salary, you might qualify for a 0% capital gains rate. 0. So billionaires who structure their affairs carefully can sell investments, realize enormous gains, and pay a lower tax rate than a nurse, a teacher, or a construction worker. This is not a loophole in the way people imagine loopholes. It is not a technicality or an oversight. It is a deliberate feature of the tax code that has survived for decades because the people who benefit from it have significant influence over the people who write it. Depreciation and the real estate shield. Now let us talk about real estate because this one is particularly striking. When you own a property, the tax code assumes the building is gradually wearing out over time, even if it is actually increasing in value. This assumed wear and tear is called depreciation. And here is the remarkable part. You can deduct that depreciation from your taxable income every year, even though you never actually spent that money. It is a paper loss that reduces your tax bill on very real income. Wealthy real estate investors use depreciation to generate what are called paper losses, losses on paper that offset real income earned from rents, investments, and other sources. And it goes further. There is a provision called bonus depreciation and an approach called cost segregation that allows certain property owners to front-load enormous deductions in the early years of owning a property, dramatically reducing or even eliminating their taxable income for years at a time. The result is that real estate investors can sometimes receive hundreds of thousands of dollars in rental income and show a tax loss at the same time. This is entirely legal, and it is one of the reasons so many wealthy people park money in real estate even when other investments might perform better on paper. The charitable giving layer. There is one more layer worth understanding: charitable giving. When a billionaire donates appreciated stock to a charity or to a donor-advised fund, two things happen. First, they avoid paying capital gains tax on the stock they donated, because they never sold it. Second, they get to deduct the full current market value of that stock from their taxable income. So if you bought stock for $1 million that is now worth $10 million and you donate it, you avoid $9 million in capital gains and potentially deduct $10 million from your income in the same move. This is why you see the ultra-wealthy making enormous headline announcements about giving away their fortunes. It is often genuinely philanthropic, but it is also one of the most tax-efficient moves in the entire financial system. Donor-advised funds in particular allow wealthy donors to take the tax deduction immediately while distributing the money to actual charities over many years, sometimes decades. What does this mean for you? Now, here is the part that actually matters for your life. You are not going to borrow against a stock portfolio to fund your retirement. Most of these strategies require scale that ordinary people do not have. But the underlying logic, the philosophy behind how wealthy people think about money, is something you can actually learn from. The first lesson is this: assets are taxed differently than income. If you work for money, the government takes a large cut before you see it. If your money works for you, through investments, through ownership, the rules are different and often more favorable. This is why financial educators consistently encourage people to start investing as early as possible. Not because it is a get-rich-quick solution, but because of how accumulated ownership is taxed differently than earned wages. The second lesson: tax-advantaged accounts exist precisely to give ordinary people access to a version of this logic. A 401k, an IRA, a Roth IRA. These are vehicles that let your investments grow either tax-deferred or completely tax-free. The government has literally built a mechanism for everyday people to grow wealth without paying tax on gains every year. Most people do not maximize them. Most people do not even understand what they are doing for them. But the billionaire who lets their assets grow untaxed for decades is using the same fundamental principle as the person who maxes out their Roth IRA every year, just at a completely different scale. The third lesson: the system rewards ownership over labor. This is not a political statement. It is a description of how the tax code is written. Understanding that truth helps you make better decisions about how you try to build wealth over time. Here is the honest truth about all of this. The billionaire tax strategies we walked through today are not available to most people. The buy, borrow, die structure, the securities-based lending, the cost segregation plays, these require levels of wealth and access that most of us will never have. And there is a real and legitimate debate to be had about whether a system that taxes a billionaire's effective rate lower than a school teacher's is the right design for a society. That debate is above this channel's pay grade. We are here to explain the system, not to tell you how to feel about it. But what is not above this channel's pay grade is this: the people who built enormous wealth did not do it by working harder. They did it by understanding how money moves through systems and positioning themselves inside those systems in ways that most people never learn. You do not have to be a billionaire to start thinking this way. You do have to understand that the rules are not the same for everyone. And knowing the rules, even the ones you cannot fully use yet, puts you ahead of most people who are playing the game without ever reading the rule book. That is what this channel is for. Taking the systems that shape your life every single day and drawing them into focus. If this one made you look at your paycheck differently, share it with someone who needs to see it. Subscribe so you do not miss what comes next. And leave a comment. I want to know what part of this surprised you most. Big ideas. Plain language. Finally clear.